Which is that most difficult part? The most difficult part is Basel III. We are all afraid of looking at Basel III. Okay, of course, Basel III is a huge topic and it can't be covered in half an hour. But then also what is required for CAIIB, that will be covered. Okay, because otherwise the topic is so huge, right? So before starting, I'll always start with my daily quote, which is very important in present times. When obstacles arise, you change your direction to reach your goal. You do not change your decision to get there, right? So when obstacles arise, when difficulties arise, you don't change your determined goal. You change the ways of doing it, right? It's as simple. Download Adda 24/7 on your mobile to get all the updates on various banking exams and the study material for the same and the various video lectures for the same. Okay. So share it with your friends also. Share it with all your friends and colleagues on the social media everywhere. Okay. Use this code Y432 to avail flat 77 or roughly 80% discount now on Adda 24/7 app. Use this as much as possible. Okay. So let's start with today's topic now. Okay. Firstly, Basel III. What is Basel III? Okay. Earlier it was Basel 1, then Basel 2 came, then Basel 1 got replaced, then came Basel 3. But remember one important part regarding Basel 3. When Basel 3 has come, it doesn't mean Basel 2 is gone. Okay. Or it even doesn't mean Basel 1 is gone to all the extent. Okay. See here, what it covered is Basel 1 covered 2 risks. Basel 2 covered 3 risks. And Basel 3 covers 4 types of risks. The number of Basel and +1 is the risk covered. Okay. So which were the two risks covered in this Basel 1 first? So it was market operations and this credit. Then Basel 3, operations, credit and market. Then Basel 2, sorry, operations, credit and market. Now Basel 3, operations, credit, market and systemic risk. Okay. What is systemic risk? See here. Because up to Basel 2, you all know this credit risk, market risk, operational risk, right? What is market risk? Market risk is that risk which is not in your hands, right? Operations means due to your operations as well as some external factors due to which your systems get closed down and there is a customer disruption or business disruption. That's operations, right? Credit means basically there are 2 types, counterparty and country. Okay. Then what is systemic then? Systemic risk means due to the failure of one financial institution, there is a full whirl which appears. Whirl means when you throw stone in the water, what happens? We get whirls, right? Whirls, waves we call them. We get waves. That waves, because of one stone, the waves appear in the whole water, right? So that is called as systemic risk. Because of failure of one bank, all the banking system or all the financial system fails. Do anyone remember this 2008 Lehman Brothers crisis? 2008, right? What happened? In that one Lehman Brothers collapsed and all the banks were in the problem. So that is why. Why does this happen? So that is because all the banks, all the financial institutions are nowadays interrelated with each other. How they are interrelated? They are interrelated through bonds and warrants. Bonds are generally for governments and private institutions issue various names like warrants or there are other names as such. So if somebody purchases the warrants or some debt instruments from that bank or at that financial institution and that financial institution collapses, then what happens? Then the paper which you have purchased becomes zero. So that's why the whole banking system or financial system is in trouble. Okay. So that is a major crux of Basel III, systemic risk. Okay. So it covers, what does Basel III cover? Basel 3 covers the liquidity risk in addition to Basel 2. Remember, in addition to Basel 2. So credit market operations as per Basel 2, it's there. It's not gone. In addition to that, we cover this Basel systemic. So what are the three pillars? Again, you will see the similar pillars as in Basel 2 only. Minimum capital requirement, SRP, and market discipline. Right? SRP is supervisory review process. That I have already covered in my Basel 2 lectures. Okay. So minimum capital requirement. So these are the important parts in Basel 3 for minimum capital requirement. We'll see one by one. There are ratios available for this. We'll see them. Liquidity coverage ratio. I'll cover this separately. LCR, Nsfr, net stable funding ratio. Because now I'll in this slide I'll only cover that which is not covered further. Okay. Otc derivative charge. Now this part I have not covered anywhere else in further slides. So this I'll explain you. What is Otc derivative charge? Here, what does RBI say nowadays? Or for that matter, any central bank says, any central bank says to the banks that whenever you are dealing in bonds, don't deal in OTC products or try to resist from dealing in OTC products. Means if I have to purchase bonds, don't purchase it directly from somebody who is selling because you don't know the credit worthiness of that guy. So what do? Bring a third party in between. Who can be the third party? Anything, any credit agency, CCIL, or anyone who is able to do the risk rating of that issuer and only then purchase it. Then you'll say, oh, who will pay the charges? Of course, there would be charges. It's like the broker while purchasing the land. If you directly purchase it from someone, then you save that brokerage. But there's the job of the broker also. When he takes 2%, what does he do? He checks the creditability, credit worthiness of that land, whether that land is that much worth. Same thing is done over here by the third party. Okay. So OTC derivative products charge means what? If you purchase it from OTC, means over the counter, you don't bring any third party in between, then there will be a charge. Why? Because you're putting the public's money at risk. Okay. But if you take some third party rating, then this charge won't be there. So that's why what RBI is saying is that's important. RBI is telling everyone that don't go for OTC products nowadays. OTC products in the sense for derivatives or bonds. Okay. Not you'll say tomorrow FD is also an OTC or loan is also an OTC. It's not that. Banking business which you are doing, OTC loans and this FD, that you have to continue it as a OTC only. Okay. Next is quality and level of capital. So quality and level of capital means what? What type of capital is required and what is the level of capital required? That will be covering in the last slide over here. Leverage ratio, again we are covering it. CCB's capital conservation buffer, we are covering this again. Okay, I'll explain it at that time. Counter-cyclical buffer, again we are covering. Now, what is it? Just I'll give you a gist in short, these two buffers. Capital conservation buffer and counter-cyclical buffer. Remember, capital conservation buffers are to be implemented by the bank themselves. It's generally 2.5. So they are to be implemented by the banks in addition to their tier capitals, means CRARs. Okay. So if CRAR as per RBI is 9%, total CRAR, then the CCB will be in addition to this 9%. So your CRAR with addition of CCB will be 9 plus 2.5, that is 11.5. Okay. And after that, after this 11.5, if there is some problem in the system or there is some, let's say there's a huge famine in certain country. Okay. In that case, what happens? Or there's a big riot or something happens in certain country. In that case, what happens? In that case, the central bank puts a counter-cyclical buffer, which is in the hands of the central bank, that is RBI in India. Okay. So this buffer is implemented by the central bank or RBI, and this buffer is implemented by the individual banks. Okay. Enhanced loss absorption clause. Now this is always important because this is a part of the capital part. Okay. Means that's why minimum capital requirements have increased over here. Okay. So enhanced loss absorption clause should be there. Means every time the loss absorption capacity which we had in Basel 2, now that is to be increased in Basel 3. Okay. So what was there in Basel 2? Basel 2 we had for those three risks, right? That operations, market, and this third one, right? Credit. So here we are increasing it using these buffers. Basically CCB and this counter cyclical. Okay. Also we are increasing using this LCR and Nsfr. We'll study them. Pillar 2 and Pillar 3, SRP and market discipline. This will cover if time permits. Okay. Because for CAIIB, this is important. Questions are asked on Pillar 1 only. Okay. Pillar 2 only ICAP is asked. That I'll be covering in some separate lecture. Okay. Because it's a huge topic. ICAP, SREP and ILAP. ILAAP. These three are individual topics, means combined topics, which are to be covered separately. Okay. So SREP will cover this supervisor review process. It will cover ICAP, ILAP and SREP. We won't be covering it in this lecture. Similarly, market discipline. This will be a separate altogether lecture, right? Because your disclosures are important. What type of disclosures should be there? Means consolidated balance sheet and standalone balance sheet. That comes over here in market discipline. And also there are means if more than 500 crores, then what is the level of balance sheet to be given? Less than 100 crores, what is the level of balance sheet to be given? Means turnover of that bank or capital of that bank. Okay. So now our focus is only Pillar 1. Now, Basel 3 is a list of comprehensive reforms whose goal is to strengthen the regulation and supervision and risk management of the banking sector. Basel 3 framework is built upon Basel 1 and Basel 2 frameworks. Okay? So whose goal is to strengthen the regulation, supervision and risk management. See here, regulation means what? It's a self-regulation which the banks have to follow. Supervision means what? This is from the third party. And risk management is done again by the bank. But here the role of the central bank also comes. Okay. So risk management of the banking sector overall. See here, Basel 3 generally takes the broader view, not on individual bank basis, but it takes on the banking system as well. Okay. Now, what are the peculiarities of Basel 3? See this. Higher tier 1 and tier 2 capital requirement. This serves as a buffer to absorb shocks during the financial crisis. So, what is tier 1 capital? I've covered this in my earlier lectures. What is tier 2? Earlier lectures. So, just giving, we'll give you one-liners. Tier 1 is a free capital, okay, where you don't have to pay any binding to someone. Means if I take a loan from you, then it's not a free capital, right? But if you invest in my business, in my using stocks, then it's a free capital. Because I'm not bound to give you anything on that stocks. Because stock market or equity market is what? It's a risk business. So tier 1 is always free capital or riskier capital. Tier 2 means what? That is a paid capital. Paid means what? Not paid up. It's paid capital. What do you mean by paid capital? Paid means if I take a loan from you, let's say 10 lakhs and invest it in my business here. So what will you say? Either you earn or don't earn in that business. For me, it is pay my EMI. That's it. So that is tier 2 capital. So tier 2 always has a fixed liability. Tier 1 doesn't have a fixed liability. Okay. So higher tier 1 and higher tier 2 capital requirement. This serves as a buffer to absorb shocks during the financial crisis. CCB, capital conservation buffer. This is mandatory additional capital that is required to be held over and above the minimum capital requirement. So this is a mandatory capital requirement over and above the minimum capital. Minimum capital requirement is what? As per Basel 2, it was 8%, and as per this RBI, it is 9%. That 9% is also increased now. Means for various banks, depending on what business they do, right? Means if some bank is doing some insurance business, then it is 10%. If for nationalized banks, it is 12%, right? So in addition to that, we have to use this CCB. Okay. So always remember this. CCB is in addition to the minimum capital requirements. Okay. Counter-cyclical measures or counter-cyclical buffer, you can call it. These are regulations used to deal with cyclical changes in the balance sheet of the banks. Means what? If cyclical changes, now cyclical means what? There are 4 types of just cycles, right? Which one? We had studied that during our ABM. Okay, that seasonal, cyclical, secular trends. Remember all those? So what was cyclical? Cyclical means which comes within year. Every year it comes. Like the flu. The flu, whenever there's a rainy season, you get a flu. Okay. Whenever there is huge cold, you get a flu. So there are huge these lines in the doctor's cabins, right? So same thing over here. So cyclical, used to deal with cyclical changes in the balance sheets of the banks. Means even banks have cyclical ups and downs. And to deal with that, this central bank, RBI imposes counter-cyclical buffer. Okay. So it will be imposed on all banking system. It won't be imposed on a single bank. Okay. Then liquidity standards. Liquidity standards are contain 2 ratios. That is LCR and Nsfr. Liquidity coverage ratio and net stable funding ratio are the 2 liquidity standard ratios being mandated. Now, what do these both contain here? We are taking this in another slide, next slide, but just give you a gist or in a short. LCR covers run on the bank. Run on the bank means what? What do you mean by run on the bank? If tomorrow some bank fails, what happens? What is the first step taken by the customers? If you come to know, this generally happens in cooperative banks. Okay. When some cooperative bank fails, what is the first step taken by you? Suppose you have a deposit in that bank and there's a failure of that bank or there's an administrator which is set on that bank. So what is the first step you'll do? You'll run to the bank and try to withdraw a deposit. This will happen for all the customers, and this is called as run on the bank. To cover this run on the bank, this LCR is used. Short term, if there is a short term withdrawal. NSFR is long term funding, means for 1 year. Okay. Now both these are maintained in terms of government bonds. Okay, short term bonds, of course, generally T-bills. So are the 2 liquid? So these both contain high liquid assets. That is, high liquid assets means all the treasury bills, G-Secs, everything which can be sold immediately. Next is capital leverage ratio. These are used to determine capital adequacy of the banks. It also puts a constraint on how the bank may leverage its capital. Now, what do you mean by this? This is used to determine capital adequacy of the bank. Now, leverage ratio, we are again covering it in the next slide. Okay. So, what do I mean by this? But leverage ratio means what? What do you mean by leverage? What is leverage in practical life? Leverage means how much can I, suppose if there is some problem tomorrow, how much can I sustain? Okay. How much can I take a leverage from my other assets? It puts a constraint on how the banks may leverage its capital. Means if leverage its capital, what is the leveraging its your own capital? If let's say I'm having some stocks, okay, and if I put them in as a loan, means as a collateral for the loan, that is called as loan against shares. If I take loan against shares against those stocks, then is it a free capital now? I've taken the funding on that, right? So I've leveraged that basically, used that capital. So this, even the banks do the same thing. How will the banks do the same thing? Suppose if they have assets of, let's say, standard assets of home loan. Okay. Home loan, huge home loans. Okay. So it's a standard asset. That is the asset. How can they leverage it? They can use the CLN and CLO, right? Credit linked obligations and credit linked notes. Okay. They can use that. When they are using this, That is called as leverage. Means what are they doing actually? In both these are separate topics, but what do? They prepare small chunks or small packets of all the bonds, of all the home loan bundle, and they sell it to individual customers, investors, and those investors invest. And what happens then? These banks get the money. These banks have already got the money. It means the bonds are sold. If tomorrow these home loans fail, then who is the loser? Bank is not a loser. The investor is a loser. But to what level can bank do this? That is called as leverage. And that is a restraint put by RBI. Okay. Now the important ratios from CAIIB angle. You'll definitely get questions on one of these. Definitely. Okay. So capital ratio. Eligible capital upon RWA. This is common for any Basel. Basel 2 also same, Basel 3 also same, Basel 1 also same. So eligible capital. Eligible capital means what? Tier 1 plus tier 2 upon RWA. RWA means what? All the three risks. Which one? Capital plus this market plus operations plus as per Basel 3, all those buffers applied. Okay. So add these tier 1, tier 2 and just divide them. You'll get the CRAR, capital ratio. Okay. LCR, liquidity coverage ratio. I told you this is a short term, right? High quality liquid assets mean generally G-Secs or government bonds or treasury bills. Okay. Upon total net cash outflows over the next 30 calendar days. Now, what can be the net cash outflow? If you have a run on the bank, then everyone will try to withdraw their funds. Okay, so this covers that situation. That's why high quality liquid assets upon total net cash outflows over the next 30 days. Okay, then it should be greater than 1 or 100% in percentage wise. Okay, then leverage ratio. Leverage ratio equals to tier 1 capital upon total exposure. See here, what did I say about shares? If I am having the shares, tier 1 capital is what? Free capital. Free capital means what? Shares mainly. In tier 1 capital, there are various elements. Okay. But the main element is equity. Okay. Means main, which covers almost 80%. That is equity. So tier 1 capital upon total exposure. Total exposure means what? All your loans. Not only loans, including the bonds. Okay. Bonds which you have purchased from somebody. That is called as exposure. Okay. Because if that issuer fails tomorrow, your bond is a zero price piece then. So that should be greater than 3%. Next is Nsfr, net stable funding ratio. Available stable funding upon required stable funding. Now, what do you mean by this? Available stable funding. How will you have this available stable funding? You will have this stable funding through point number 1. If you hold this freely available government bonds, okay, means if I am holding the government bonds of 12 months or something, this is generally for 12 months, okay, and this LCR is for 1 month, okay. So if I am holding these bonds, which are government bonds, they should be very high rated. Okay, so government bonds don't require rating. Central government bonds. Upon required stable funding means what? Available upon required. Both stable funding is same. Okay, so what does it mean? Required means whatever is required for my bank to keep this bank safe for at least 1 year. So that should be again greater than 100%. Okay. So what are the requirements now as per Basel and as per RBI? This we have covered many times earlier also. Minimum CET 4.5 as per Basel and as per RBI 5.5. So you'll have a question, which should I follow, this or this? So you should follow RBI requirements for banks. But for exam, if they ask you as per Basel requirement, then you have to write 4.5. As per central bank requirement, you have to write 5.5. Okay, or RBI requirement. So 4.5, 5.5, CCB 2.5, 2.5, that is same. So if you add them, you get 7 over here you get 8. Additional tier 1 capital 1.5, here it is 1.5, same. So Minimum tier 1 capital 6 and here it is 7. Here everything is added by 1 by RBI. Okay. Tier 2 capital 2 same kept. Minimum total capital ratio. So it is 8 and it is 9 over here. So tier 1 plus tier 2 total is 9. Now CCB added. So 8 plus 2.5 is 10.5. 9 plus 2.5 is 11.5. This 2.5 came from here. Capital conservation buffer. Okay. So always remember this 5 RBI has one more than this Basel. Okay. So that was the purpose of this video. So hope so you have understood this Basel 3 requirements and you'll study deep. Join our paid classes also. There we cover huge bigger lectures for this and you'll get a better knowledge over there. Okay. Use this code Y432 to avail a flat 77 to 80% discount nowadays on this Adda 24/7 app. Keep studying. Okay. And share it with your friends also. Download this Adda 24/7 app on your this mobile. Share it on the social media. Okay. Bye from my side.